Morning, everybody. We're just going to give folks an opportunity to sort of get in here. Jen, I don't need to be on camera to keep us rolling, right? I could just, my voice is good enough. We got to get that intro video, by the way. All right, cool. Talking. Right now I'm talking to myself, by the way. Or I guess I'm talking to you. Monday. We're going to be able to cut this out of the replay, by the way. Where's Brent? Where? No, because it's live. Where are all my guys that were on the other one? We should go back to the other one, by the way. We had more people join live on the other one. The whole point of moving to this is to get people to join live instead of all the people that watch on replay. And we have fewer people joining live here. I think Nick Kiefer hasn't been on this one yet, has he? He was nice. He was as they say in radio, a long-time listener, first-time caller or whatever. Where are my regulars? All right. Anyway, we have here in 5 minutes, bonds opening slightly better. We've got PPI and jobless claims. Seth, you on here? I'm seeing us up a tick or two. Nothing too dramatic. Still really well behind best levels for the week, 6-7 ticks. We sold off into the close yesterday. A little bit of a pop overnight on some renewed optimism about the end of the conflict or whatever we even want to say. We're talking about Iran delivered a response to Pakistan, and apparently they in Qatar, sort of put the pedal down. The president said the U.S. will be taking oil infrastructure points and Karg Island. So, I don't know. Are those good things or are those bad things? I think what's interesting is that the president is talking about releasing all those reserves and how that's moderated gas prices. In the conversation, or oil, or both, in the conversation about inflation, he's sort of, if you saw that, he's almost declared victory on inflation already, because he said, well, once this is over, we've been able, and listen, I would expect nothing less, right? I mean, of course, he's going to, have some rose-colored glasses on this, but, the logic is somewhat fundamentally sound if all things were to remain equal, which they never do, by the way. But if we were able to keep the price of oil in the 80s and 90s in the midst of this conflict, in theory, right? If we keep everything equal when it's done, you're potentially looking at 50, 60 cents, $50, $60 a barrel. And in that case, if the inflation is truly transitory, and by the way, I really enjoy Russell Mack's posts, and where I disagree a little bit with his post on inflation yesterday, while literally he's right? The price of oil, the price of gas seeps into the price of everything. I think that the reason why we tend to want to strip it out is exactly in the language. And I'm going to really quickly, just so you hear it, from somebody other than me. This is the AI and, who knows, Webster's dictionary definition of core CPI. Core CPI, Consumer Price Index, is a metric that measures the average change over time in prices paid by consumers for a standard basket of goods and services, explicitly excluding, and this is the word that I wanted you to hear, that's not my word, it's the word, volatile food and energy costs. And, what's interesting about that is I'm not so convinced that food costs are that volatile. We looked at the 20-year run CPI chart, and the cost of bananas, for the most part, haven't done a darn thing. Now, on a percentage basis here and there, perhaps, right? If the cost of bananas goes up 5 cents, that's 10%, and that is volatile. But certainly the cost of energy is, and particularly oil and gas, or oil, gasoline at the pump, is particularly volatile. And so you don't want those anomalies. And we talked about that trimmed CPI that the new Fed chair, Warsh, is likely to advocate for, is intended to kind of strip out, better than that volatility, more so anomalies and outliers, or at least as they're perceived by those who are viewing it. So long story short, while I can't find fault with the logic that at some point looking at core is meaningless, I don't know that we're at that point here, and that's the point. Anyway, let's take a look at some news from today real quick. Overnight data. What do we get? We got 73 data points. Miss on the numbers. Little beat here, but that's on the yearly. The monthly kind of on the number. So we're seeing at these, it makes sense. Everybody kind of drops their data at the same time. We've been talking about some inflation relief. You're seeing that here, kind of across the board. We'll see. PPI and claims just dropped. Let's see what we've got here. Claims 229, very bond friendly, expected 219, continuing up 1795. We've been below 1800 for a while. Revised down, however. The net is still good for bonds. Core PPI missed and revised down from 1 to 0.7 last month. We expected 0.5, came in 0.4. Headline beat 6.5 versus 6.4. However, last month revised from 6 to 5.7. Core annual expected 5.4, came in at 4.9, and last month revised down. But the monthly hot, boy, which is somewhat inexplicable given all these sort of misses and but whatever. 1.1 versus a 0.7. Last month revised 1.4 to 1.1, so even. Our first move is worse. I don't get it. One, I don't know that we give a good goddamn about PPI. But two, to whatever extent we do, while these are not great numbers, right? A core of 0.4 is still annualized 4.8. We were expecting 6. Okay. Last month printed at an annualized rate of 12, and we got 8.4. These are big misses. It's hard. How about this? If nothing else, we certainly want to breathe a sigh of relief on this number. I don't know that you feel good about it. I'll keep going real quick. GDP miss. I mean, and I said this yesterday, I'm going to say it again. We've got ECB. Did ECB already? I didn't. Let's see what ECB is doing. Not yet. 18 minutes ago. Okay, here's the press release. The Governing Council is committed to setting monetary policy to ensure that inflation stabilizes, blah, blah, blah. It decided to raise three key ECB rates by 25 basis points. The war in the Middle East is generating inflation pressures, and the decision to raise rates is robust across a range of scenarios, mapping out shock, blah, blah, blah. Headline inflation is expected to average 3% in 26, 2.3 in 27, 2 in 28. For inflation excluding energy and food, 2.5, 2.2, and 2.2. Compared to March, they revised their expectations up. Economic growth at 0.8, 1.2, and 1.5 the next 3 years. So that's a downward revision. We'll talk about their QE, and they're saying their ports are declining, but I don't see any language in a change in whether they're going to QT or QE. So long story short, if you remember, right, how many times has the Fed raised rates and rates actually went down? So today's ECB decision, and to whatever extent that might color the bias going into the Fed decision on Wednesday, next Wednesday. What I would say about that is, how many times have you seen the Fed hike rates and rates go down? Why? Well, there's a component to it. And if you read the ECB language, and as a bond participant, one might be encouraged, might be inclined to buy versus sell here, is they have a more hawkish stance on the economy, right? And tightening could potentially further degrade economic expansion, right? So what does that mean in the future? Lower interest rates. How do bond market participants, bond traders trade? Do they trade on today's news, yesterday's news, or tomorrow's expectations? A little bit of all, but tomorrow's expectations. So that's why you might see this ECB announcement age pretty darn well for bonds. I like it. I think anytime you get a Fed committee, hey Bob, you get a Fed committee to talk about concerns about the economy, that's got to get your curiosity up about future rate cuts, even though we're looking at a today rate hike. In terms of the markets, overnight, I'm not going to share this screen, but overnight, stocks mostly worse in Asia, mostly better in Europe, indicating up 0.75 point to 1.5 points onshore. Volatility down a little bit. Bitcoin bouncing off of its absolute lows. And as you might imagine, based on this Pakistan news, so on and so forth, price of oil down about a point or so, 88 and change crude, 90, almost 92 for Brent. And actually all commodities down, or at least the ones we look at pretty much across the board. Dollar stronger versus almost every currency. So yeah, I don't know if it was, 2 weeks ago, 3 weeks ago, whenever it was, but I was pretty adamant about feeling like the data was going to a dangerous place for bonds. And I'm looking over here, the camera's over here, but it's more, I'm going to move the camera for tomorrow. Although actually, I will be doing this from here tomorrow. How about I do this? Can I do that? Here we go. And it's crooked. this is probably terrible for only absolutely this is sort of like the, I don't have a film degree, but I think this is what somebody would do to create drama. Anyway, the market's turning a little bit more. I'm surprised that we're not digesting this PPI number in a positive way. I'd be surprised, war news notwithstanding. I'd be surprised if we don't end positive on the day. I think that the market, while the market's never wrong, I think we're offside on this number. I think that this is a further indication, and I go back to what the president was saying yesterday. I think that this is further indication that if we do end some sort of conflict and we do project out that we can get oil down to, $50, $60, $70 a barrel, right? That we're going to forget pretty quickly about some of the inflation pressures that we're experiencing. And oh, by the way, what do I think the biggest threat really is to our economy? And that's not inflation, right? That's stagflation. So what has reversed over the last 2, 3, 4 weeks is we are seeing some cracks in these economic reports in the economy. And so any sort of stabilization of price and potentially disinflation that is created by virtue of a drop in oil prices. And if we could say, hey, while I'm not convinced the consumer is dead, those reports have not yet really been fully realized. If the consumer is slowing and the price of oil is dropping like a rock, two big ifs, then today's news and yesterday's news on any print isn't going to matter. If we pulled a 3-year chart, you're going to find, periods in time. I mean, real quick on fives, we do a 5-year chart, 2023, March of 23, fives were pricing 2 points better than today. 2 points, a par handle in 23, right? You go to 22 in May after it was kind of over. We were 5 points better than where we are now. And so the question that I think begs to be asked is, if, right? Are we looking at better inflation numbers in 27, 28 than we expected to look at in 23, 24? I think that answer is a resounding yes. What I will say is, if you go back and look at some of my market minutes from 22, what we were talking about, back then was that we need to get through a cycle and we need to stop printing money. And so how did we get to a run up to where fives by October 23 were pricing 93, almost 92 handle, right? 6 points worse than today, were the expectations that things might get even worse. So, long story short, feel a lot better than I did 2-3 weeks ago about the prognosis for interest rates. We're starting to turn green already here, so maybe we didn't have to wait until the end of the day. What's my prognosis for today? Well, again, you should have probably locked yesterday morning before. I don't know if there were negative reprices, but long story short, I would venture to guess that you're going to see rate sheets today that are slightly worse than yesterday, depending on when folks struck. What I would say to you is same as yesterday, right? If I'm off base on 5 coupon, 5 1/4, 5 5/8, I'm still off base. I think you could still lock a quasi dip if it's a new app and maybe have a good story to tell there. I'm maybe slightly closer to a float bias on 5 3/4 to 6 1/8, simply because I just flat out disagree with this reaction to PPI and the ECB decision. I get it. I get maybe we're poo-pooing the Pakistan news and the fact that we might be getting closer to the table, but or an end, but I don't know. And then the 6 and a quarter and up, 6.5s are right there for me. So 6 3/4 and higher. I'm slightly more float biased today, but you're running out of time for June. So on June closings, I think there's value 6 1/4 and up. I think that there's slightly less value 6 1/8 and below. And, I think either way, you're probably at worst day to day on this stuff. So if you don't have any questions here, remember, and post them real quick if you do. Remember, bulls and bears make money, pigs get slaughtered. Thanks for joining live, watching on replay. Tomorrow, I think we just have 10 o'clock data. Now, normally I would say, hey, let's push this off to 10 o'clock tomorrow, but I can't do 10 tomorrow. So we're going to still be on same time tomorrow, but we'll talk about how to manage the 10 o'clock data. Thanks for joining, guys. Have a great day.